From what I can see, it was a momentary pullback. I think there's uncertainty around growth in the marketplace, primarily more so than a backup in rates in the long end. So as investors are trying to digest the trade impact on growth, where things are going, the Fed's raising rates based on the data they have, and I think we have to trust the Fed that they've got good data. And same thing with the central bank in Canada. We've got good data models. We understand the impact of tightening on cash flow of consumers, cash flow of commercial and businesses. What you can't model necessarily is these effects around trade and geopolitical facts, which confuse the situation. So investors are trying to digest, long-term growth and where they're going, and I think there's a market pullback. But if you look at, even credit markets, investors are buying the dip, which is a strong signal. So.
Right. The pullback in the equity markets last week was sparked by a build in yields in the credit markets from the week before that had started.
It was certainly as rates start to back up quickly. But again, you try to digest long-term growth. You've seen kind of volatility re-enter the marketplace, but overall, I think you're seeing strong economics out there. And you look at the bank results, beating expectations. Our results in the first 3 quarters of the year very strong. Consumers are spending, consumers are paying their debt. Commercial enterprises are borrowing. Margins are going up in the banking industry. So net, we're seeing a strong economic growth and strong fundamentals out there, which should encourage people that we've got a strong runway ahead of us still.
We've talked a lot about the U.S. banks and what they see this week because we've heard from so many of them in earnings reports. Is it true that you can see out about 18 months, at least get a good horizon to say that there's not going to be an economic pullback coming in the next 18 months because it would show up in your numbers somewhere?
Exactly. We look at consumer spend, consumer delinquencies, what are commercial enterprises and corporate enterprises? They're investing, they're acquiring. They're coming to us for borrowing, so we're seeing strong commercial loan growth. We're not seeing any early stage delinquency in any of our books right now. So that's for the first 3 quarters for us. So very strong economy, low unemployment, healthy, and rates are going up appropriately to manage inflation. So net, we're seeing very healthy growth. I worry we're going to talk ourselves into the next cycle.
What do you mean?
In the sense that if we keep trying to predict we have 18 months left or we have 2 years left, there's a psychology out there that you have to be careful of. We can't see forward. So I think you're right. 18 months is the best we can see, maybe 2 years. We don't see it. And any signals yet. But trying to predict that is really hard. So we look for signals. We look for credit markets. We look at how consumers and commercial are behaving. And it's very positive right now. We're feeling good about things.
The United States is your second biggest market. 23% of your total revenue comes from here. So you must be relieved to see that there is a NAFTA 2.0 that's been put in place at this point.
Absolutely. I think it removes one of those uncertainties in the marketplace, an overhang over trade, overhang over investment. We certainly saw clients kind of hesitating to invest in machinery, equipment, growth, acquisitions. We preserved, I think, the most important parts of the old NAFTA agreement being the sunset clause. Very important to have a longer duration maturity of any type of trade agreement. If you shorten that trade maturity window, people start to think in short term. So we protected the sunset clause. Chapter 19 was very important to both Mexico and Canada as far as dispute mechanisms, trading with a much larger partner. So the core elements of NAFTA were preserved, I think, going forward. And for that, there were certain trades around dairy, IP extensions, which I think were appropriate, de minimis e-commerce transactions across the border. So, Canada and Mexico had to give, certainly, but protected NAFTA, the auto component of NAFTA, which is largely balanced between the United States and Canada. I think there's a very small deficit in auto trade and parts, but overall, we protected that. There wasn't Section 232 tariffs on NAFTA.
But you would have seen much bigger concerns had that not gotten put together. Obviously, it still has to go through Congress, but
absolutely has to be ratified by all 3 countries going forward. And the devil's in the details, as we know, when you get lawyers involved and you start papering deals. There's lots of questions. But yes, you would have seen an extension of uncertainty in the markets, absolutely, and you would have seen a pullback in investment, and I think growth would have slowed for sure.
Dave, one thing. Oh,
go ahead. No, go ahead.
Dave, one thing we talked about with Larry Fink was the slowdown we've seen in housing here in the United States. And again, this is your second biggest market. May not have the same issues that are happening there, but he said it's in part because of the tax changes that went into place here. It makes it less affordable because people can't write off as much. And that matters not only in the blue states and some of the coastal states, but also in big cities like a Dallas. What do you think about that? How would you explain the weakness that we've seen in housing? He said it really matters when interest rates go up 100 basis points as a result.
It does. It's a combination of rates and tax deductibility changes your appetite for how much house you can buy. So you're looking for a smaller home, it changes your demand for mortgage debt in the economy, and therefore we're seeing purchase mortgages activity from a unit perspective decrease, double digits, and you're seeing the dollar volume per unit decrease because of the tax effect. So when you combine both, you're certainly seeing a slowdown, albeit still pretty good marketplaces when you look at the bank results. For our business, we're focused on the upper end of the marketplace and the ultra high net worth customer who remains active in the marketplace. So less impact in RBC, but more for a general mass consumer bank who are reporting this week could have a bigger impact for sure.
I wanted to ask you about Saudi Arabia because the Saudi relationship with Canada has been strained this summer. And one of the things that I know some of the executives who've been thinking about whether to go to this conference or not have been thinking about is actually the retribution that took place from Saudi to Canada after this skirmish, this war of words, effectively, that became much more than a war of words, including an order from the Saudis to sell Canadian assets.
Yes, they did. Yeah, liquidated their portfolios.
What is your take on what's happening in Saudi right now, and does the relationship with Canada matter?
Well, I think we're a net importer of Saudi oil into the East Coast, and I think one of our challenges as a country is getting our oil from our oil-producing region of Alberta to the East Coast to the Energy East pipeline, which we haven't been able to get approved and through, and that would diminish our reliance on Saudi oil. But certainly, to the core of the question, I think you asked Larry, is as a CEO, you have to put the principles and values of your organization first, above your economic interests. I think this is a case, albeit still facts have to come out, and I think it's appropriate not to overreact until the facts come out, but you have to definitely put the principles of your organization first in this situation. And I think that's why you're seeing global CEOs certainly react that way and react appropriately that way, and we'll see what the facts bear. But right now it's a difficult situation for sure.